Module 4, how to get the best interest rate. Obviously, that's of the utmost importance. There's a lot of data that America doesn't know about the bond market, interest rates, Fed rate, how the ebb and flow of the markets work. So we're going to teach you how to get the best interest rate by being educated on all of those components. Another one of my favorite topics, getting the best interest rate. So mortgage interest rates. Let me start with this. Many of you hear that the Fed rate is being raised or being lowered. Everybody thinks that that's the mortgage rate. It's not. When the Fed rate is lowered or raised, that's the money that they lend to the big institutions. So for example, if the Fed rate's 4%, that's the money that they lend to Bank of America. Bank of America then takes that interest rate and it lends it back to you guys in the form of interest on a savings account or a commercial loan. So the Fed rate going up and down is a direct reflection of what they want to lend out to the banks, and then the banks relend it to us. Now, mortgage interest rates are somewhat related to that because obviously where rates are on a holistic level, have everything to do with what's going on in the country. But the bond market, the mortgage-backed security pools, which is the buying and selling of the mortgage bonds, are where rates come from. So let me explain. Bonds are a big giant mansion, okay? The Fed rate is the entire town. But within that mansion, there's different rooms. And one of the rooms might be the 30-year fixed 6.25% bond. Another room might be the 15-year fixed 5.5% bond. And the buying and selling and trading of those notes dictate whether money's flowing into the bond market or money's flowing out of the bond market. So let's talk about world markets for a minute. There's usually stocks, bonds, and commodities, right? Commodities, oil, gas, silver, gold. Typically money flows out of one and into another, and sometimes they're flowing into two and out of one. So a lot of times, if you see the stock market selling off, money's flowing into bonds. If money flows into bonds, it has a direct reflection of pushing rates down because bonds are seen as a little safer. So in order of risk, stocks most risky, bonds are next, and then commodities are the least risky. So when mortgage bonds are traded, right, if money flows in, rates go down. If money flows out, rates go up. That's where rates come from. The Fed rate is different. That's what the banks get it for. Now, this is bonus material. Have we ever heard of arbitrage? Who knows what that is? Arbitrage is when the bank, say Bank of America, takes a 4% interest rate from the Fed. They can actually lend at 10 times what they get from the Fed because they're a bank. They take that 4% cost, right? They lend it back to you on a credit card at 22%. So that's why the banks have all the money, because they're actually making that spread. They're making 18% spread. That's arbitrage, okay? Bonus. So with the bond market, lenders have to understand what's going on. And I subscribe to a service that shows me the buying and selling of the bonds every day. So we have to time the market so that we can get our customers the best rate. So interest rates come from the buying and selling of the mortgage-backed security pools on Wall Street. So now here is a nice segue from the better rate and putting less money down. I'm going to show you an example. This is a 15% down versus the 20% down model. Let's take a $400,000 purchase. With 15% down, you're out of pocket $60,000. Okay? Your interest rate is going to be 0.25% better. You also can buy out the mortgage insurance. If you have a 740 credit score, it's around $2,850. And you keep $17,150 in your pocket. Now let's move over to the 20%. With the 20%, you have to put $80,000 down. You don't have a buyout, but your rate is 0.25 point worse. And if you look at the two payments, The payment with the 15% down is $2,149, not including taxes or homeowners. That's just principal and interest tax. That's just principal and interest. And the payment on the 20% down is $2,075. So it's $74 more to put 15% down, but you've gotten a quarter better on the interest rate, and you keep $17,150 in your pocket. Why is this important? I see too many homeowners take all the money they ever saved because grandma told them to put 20% down and that's the best thing to do, and then they're broke. And then they call me 2 years later because the roof is leaking and they need to spend $18,000 on a roof and they don't have any money. So when I look at teaching first-time home buyers how to buy real estate, we want to make sure that we allocate our money properly. I believe you're much better off, quarter better on the interest rate, $17,150 in your pocket, and the payment is only $74 more. Definitely a win-win to do that. So a little bit more bonus material just to understand the value and power of owning real estate. So let's look at the appreciation numbers in Florida over the last 10 years. 10.81%. Crazy. Last 20 years, 6.07%. Now, if you look at certain cities like Fort Lauderdale, 5.8%, Tampa, 6.27%, St. Petersburg, 6.45%, Miami, 5.52%, Orlando, 4.64%. So the numbers have really gone up a lot. Now, if you look at nationally, New York over the last 10 years is up 6%, probably because it started at a higher number. Last 20 years, 4.96%. Texas, booming, 8.34%, right? And Florida's still number one at 10.81%, but California is up 8.43%. So our brains don't really understand the value of compounding interest, especially with appreciation. But if it's 10% a year, year over year, that number grows dramatically. So speaking of appreciation and the cost of real estate, when my father bought his house in Livingston, New Jersey, where I grew up, in 1973, guess what he paid? He paid $27,000 for a 4-bedroom, 2-bath house. And my grandfather told him he was crazy because it was too expensive. Now that's funny now, right? But if we look at the median sale price of homes in the United States, 1950 was $7,354. 1960, $11,900. 1970, $17,000. 1980, it jumped, $47,200. 1990, $79,100. 2010, $222,900. And look at 2020, $329,000. Now, New York, New Jersey, Florida, California, Colorado, values are way higher. This is a national median average. So we have a lot of states across the country where the median average is lower, but this is just to show you that our brains, if we bought a house in 1980 and did nothing but pay off the mortgage, we bought it for $47,200, that same house on a median level would now be $329,000. That is, quick math, 6 or 7 times the value of what you paid for it. You can't go wrong in real estate. We need somewhere to live. We talked about all the other reasons to own real estate, but these kind of values really help as well.